ESG screening can be applied to both individual companies and collective investment funds, but the analytical focus, available information, and evaluation techniques differ significantly. The objective in both cases is to assess exposure to environmental, social, and governance risks and opportunities, yet investors must determine whether they are evaluating a single issuer or a portfolio of underlying holdings. Screening may also be conducted on an absolute basis, where investments are assessed against predefined standards, or on a relative basis, where performance is compared with sector peers or benchmark groups. Understanding these distinctions helps investors apply ESG criteria more effectively and make informed portfolio allocation decisions. When screening individual companies, investors focus directly on the organization's ESG performance, policies, practices, governance structures, and sustainability outcomes. Analysis typically uses company disclosures, ESG ratings, sustainability reports, regulatory filings, and engagement findings. On an absolute basis, investors evaluate whether a company meets predetermined ESG standards or exclusion criteria. For example, a company may be excluded if it exceeds specified carbon emission thresholds or derives revenue from prohibited activities. Absolute screening focuses on compliance with defined sustainability requirements regardless of how other companies perform. This approach provides clarity and consistency but may not account for industry-specific circumstances or transition progress. In contrast, relative screening of individual companies compares ESG performance against sector peers or industry benchmarks. Investors recognize that ESG challenges differ across industries, making peer comparisons valuable. For example, an energy company may not achieve the same environmental performance as a software company, but it may still be considered an ESG leader within its sector. Best-in-class screening is a common relative approach that selects companies demonstrating stronger ESG performance than competitors facing similar operating conditions. Relative screening preserves diversification across sectors while rewarding ESG leadership. However, companies may receive favorable assessments despite having sustainability challenges when compared with absolute standards. Screening collective investment funds requires a different analytical perspective because investors evaluate portfolios rather than individual issuers. Collective investment funds include mutual funds, exchange-traded funds, ETFs, pension funds, private funds, and other pooled investment vehicles. Investors assess the ESG characteristics of the fund's holdings, investment process, screening methodology, stewardship practices, and portfolio exposures. On an absolute basis, investors may evaluate whether the fund complies with specified ESG mandates, exclusion policies, sustainability objectives, or responsible investment principles. Assessment focuses on the aggregate portfolio rather than individual holdings, allowing investors to determine whether the overall strategy aligns with sustainability goals and investment preferences. When applying relative screening to collective investment funds, investors compare a fund's ESG characteristics against peer funds, market benchmarks, or comparable investment strategies. Metrics may include average ESG ratings, carbon intensity, governance quality, controversy exposure, stewardship activities, or alignment with sustainability objectives. Relative comparisons help investors identify funds that demonstrate stronger ESG integration than competing products within the same asset class or investment category. This approach is particularly useful when selecting among multiple ESG-oriented funds. However, outcomes depend on benchmark selection, methodology differences, and portfolio composition, making careful interpretation essential when comparing funds across managers and strategies. Both company-level and fund-level screening approaches offer valuable insights, but each has advantages and limitations. Absolute screening provides clear standards and consistent sustainability thresholds, while relative screening recognizes sector-specific realities and competitive positioning. Company screening enables detailed analysis of individual issuers, whereas fund screening evaluates how ESG considerations are implemented across diversified portfolios. Investors often combine absolute and relative approaches to obtain a more complete understanding of ESG performance. By assessing both individual companies and collective investment funds through multiple screening perspectives, investors can better align portfolios with sustainability objectives, manage ESG risks, and identify opportunities for long-term value creation.